Hey guys, today we're going to talk about investing and more specifically passive versus active investments. Now, most investment inside superannuation or most liquid investment is held through intermediaries. These intermediaries are funds. So you own units in the fund then goes and purchases the ultimate asset, whether it's shares, international shares, property securities, commodities, whatever it is. Now you've got two diametrically opposed views when we're thinking about investing. You've got actively managed funds and you've got index funds. Now, actively managed funds function under the following premise. They say they'll have a really smart fund manager who's really well funded with a great team, and all of this will be true, most likely, and they're going to try and beat the market return in a particular sector of the market, let's say Australian shares or international shares. Index, also known as passive investing or sometimes market-based investing, has the exact opposite approach, and it says, don't try and beat the market. The market return in and of itself is actually efficient, and in trying to beat the market, you'll actually create inefficiencies which will pull down the performance of the funds, and you'll get a paradoxical effect. So only one of these two can be true for any particular market segment. Either we would see that in general actively managed funds outperform, or we would see that index funds outperform. Now, if they were both the same, if they were hypothetically equal, you would have 50% of the time actively managed funds would outperform, and you would have 50% of the time index funds would outperform, right? If that were true, then what you would look at would be some second order considerations such as, well, what are the fees on these different investment products? And then how efficient are they from a tax perspective? So let's address those first. From a pure fee perspective, actively managed funds in general are far more expensive than index funds. Index funds are far simpler. They just track the index. They track the ASX 200 or the 300 or the S&P 500. There's not much decision making that goes on in the creation of that investment. And in effect, you have a free rider effect on the information contained within the index. An actively managed fund has a lot of processes, a lot of people, a lot of systems that it needs to pay for. Now, if we look at the average actively managed fund, you could say it's somewhere between 1 to 2%. If you look at the average index fund, it's somewhere between 0.1 to maybe 0.2 or 0.3%. So you've got approximately an order of magnitude difference between the two, about 10 times more in fees in actively managed funds as compared to index funds. And the third element to think about is tax. So if we think once again about what an index fund is doing, it's tracking the market. It's tracking the index, the ASX 200, the ASX 300. There's typically not much changing in the index. Occasionally you'll have, if you look at the ASX 200, number 200 and 201 will swap, but for the most part, it's generally quite static. An actively managed fund has a lot of turnover happening, a lot of buying and selling. And so when we look at studies, what we can see is that some growth actively managed funds have over a 100% turnover rate, whereas an index fund might have a turnover rate of 2 to 3%. Now you may ask, why is this relevant to tax? Well, if you remember back to the conversation that we had about capital gains tax, you only pay capital gains tax when you actually crystallize that capital gain. The internal turnover and sale of assets, the buying and selling of the underlying holdings of the fund, that's a capital gains tax event. It's actually triggering CGT for you, even though you continue to hold the fund and you haven't sold it. So from a fee and a tax perspective, it's very, very clear that index funds have an advantage. Now let's go back to the actual performance itself. If actively managed funds were as good as index funds, then you would expect 50% of the time for actively managed funds to outperform and 50% of the time for index funds to outperform. Now, luckily, this is data that we actually have on hand. If we look at the 2024 mid-year study completed by S&P Global SPIVA, we can see that over a 15-year period, 88% of actively managed funds in Australia invested in the global equity large cap space underperformed. If we look at the Australian general equity space, so your large cap Australian shares, 85% underperformed. If we look at the 15-year return for AREITs, so property securities, you've got an 87% underperformance, a 71% underperformance by Australian bonds, and then the small to mid cap is slightly different with a lower percentage of underperformance at 56%. Now, if we leave the Australian small and mid cap aside for the moment being, it's a special case and we'll come back to it. what we can see is overwhelmingly, you've got somewhere between an 80 to 90% chance of any particular randomly selected actively managed fund underperforming relative to the index. So if we go back, the very premise of an actively managed fund existing is that it purports to beat the index. The market is going to generate a particular return, the index is going to track that market, and then the actively managed fund says, give us your money, let us invest it for you, we'll charge you a higher rate, but the outcome that we're going to try and engineer for you is an outperformance of this index, and therefore it's worth it. Well, if we've got an 80 to 90% failure rate, from my perspective, that shows a systemic inability of actively managed funds to actually achieve the outcomes they set out to achieve. That would be like having a 10-sided die with 9 of the sides resulting in your failure and only 1 of the sides being successful and you still rolling the die. So my perspective on this is that in general, actively managed funds in most of the sectors that we've examined don't work. You've got a better chance just utilizing the index. It's not to say that every actively managed fund will underperform, but trying to pick that best 10% or 15% in the entire market of actively managed funds, from my perspective, is a very, very bad bet, and you're likely to get a better return with the index. Now, if we go back to the discussion that we had before about the returns, we showed that approximately 56% of actively managed funds in the small to medium cap space underperform relative to maybe 90% in the large caps. Now, this data is supported by the efficient market theorem. Now, this was a theorem which won the Nobel Prize in economics approximately a decade ago, which mathematically proved that where you have efficient markets, those are markets where you have high liquidity, a large number of investors who are equally well informed. On average, the market is very efficient and you cannot outperform the market. On the other hand, where you have inefficient markets, those are markets categorized by low liquidity, low investors, or heterogeneous information. The market itself is inefficient, and therefore an actively managed fund approach can actually potentially achieve, on average, a higher return than simple index investing. Now, if we look at the small to mid-cap space, that would then suggest to us those are inefficient markets, and in general, that's what we would expect. So from a general principle perspective, you would say that the large caps have a very, very high percentage underperformance rate, whereas the small to mid caps, there might be an argument for utilizing an actively managed fund, but that a high degree of skepticism and research would need to be applied before deciding which fund you would invest in, as even there, you've still got a 56% failure rate. If you have any comments or questions about the video, please leave it in the comments below. We'll get to them all as quickly as we can. Thank you and have a good day.